All right, how's everybody doing today? We're back at episode 2 of this intermediate finance course. Today is Monday, January 10th. It's currently 3:45 p.m. So kind of today what I wanted to go over, instead of hopping back into another Excel spreadsheet, I want to just go over some terms and make sure that we're all on the same page, what everything means, and then I think we can move into more advanced stuff and kind of do a full-fledged look at a company, rather than just warm up. Coinbase was kind of a warm up, I would say. There wasn't too much data. We're gonna keep an eye on that. We'll keep that spreadsheet and update it every quarter. But for now, I think the best way to go would be take a deeper dive into some of the terms on the balance sheet. What exactly do they mean? So for this, I would say you got to have at least some sort of an understanding of accounting. You don't have to be an accountant by any means, but you should have some rudimentary concept, rudimentary idea of what some of these terms mean. Number one, because it's good to know, just to have. If you're talking to an accountant and they're throwing these terms around, you want to know what they mean. And number two, it can, and probably the more important point is that it can give us a better understanding of what exactly we're looking at when we're sifting through the balance sheet and income statement, things of that nature. So today, what kind of my plan is this is one of the textbooks I use for lecture, Financial Accounting for Undergraduates. It is by James Wallace, Karen Nelson, and Theodore E. Christensen. So I guess kind of what I'm going to do, if you have the textbook, that's great. It's available, I believe, on Amazon. It's something like $75. So pretty affordable for a textbook. I mean, it is, let's see how many pages it is. Over 700, almost 800 pages. So first 3 chapters, I'm just going to skip through. If you have the book, you can follow along, but it's pretty basic stuff that I don't think is really applicable to what we're kind of shooting for today. So I'm going to hop into chapter 4 here, which is understanding financial statements. I think this is one of the more crucial chapters of the text. So right now, I guess what we can do is I'm just going to read through some of these terms and kind of give you my best explanation as to what they mean. Alright, so what I've done here is I've actually opened up just a text edit page here. And I'm starting here on page 188 if you're following along in the text, and I'm just going to kind of run through here, maybe give some quick examples, and yeah, okay, we'll just hop right into it. So, typical components of a classified balance sheet. This is going to be pretty important. So we're going to have cash, we're going to have short-term marketable securities, and that's going to be like your stock. I'm going to go through and explain what exactly all these are after, but for now, we'll just get them down. Let me actually title this. So these are what? These are current assets. Let's bold this, underline it. Okay, so what else do we have? We also have accounts receivable. I usually abbreviate it A/R. That's how you'll find it on all my forecasts, and I think that's a good way to save you some time. Inventory is another one. So we'll continue with the pattern that we've got going on here. And then other current assets, which oftentimes you're going to have to look through their notes, their footnotes, and to see exactly what it is, but it varies from company to company. So what else do we have? We have non-current assets. As their name suggests, they are not current. So in this regard, when we're talking about current and non-current, current is anything under a year, and non-current is anything over a year, and it'll always be like that. Same thing with we'll get into it later, but current and liabilities and long-term liabilities, same thing. So what do we have for non-current assets? Well, we've got property, plant, and equipment. I guess we can just go here, plant and equipment. And this is always, or almost always, abbreviated PP&E. Okay, what else do we have? Intangible assets. These are a little bit more complicated. I spelled that wrong. Intangible assets. These are a little bit more complicated. These are going to be things like patents. What else? Trademarks. What else? Copyright. Things like that, where you can't physically touch it, I guess you could say. If you can't touch it, it's intangible. Another thing, not necessarily an intangible asset, but something intangible that's good to keep in mind is software. You can't touch software, so it is technically intangible. Okay, what else do we have? Other long-term assets. This is, as I said with current assets, same thing. You get to kind of sift through their notes and see what they classify that as, and it varies from company to company. What are we doing here? Okay, what else? Okay, so now we're going to head down to current liabilities. One way to think about liabilities, they're interchangeable. You can just say you're on the hook for it. So you got to pay it at some point. So what do we have in here? Accounts payable. I guess we should probably write these out just to keep it specific. Accounts payable. But as with accounts receivable, as you see up here, right here, it's also abbreviated A/P. And I guess we'll just type it out up here too, just to keep it consistent. Accounts receivable. And that's people that owe you money. Accounts payable is people you owe money to. Or money you owe to others, I guess is a better way to put it. The people aren't the payables, the money is the payable. So, accrued expenses payable. We can go more into that in a little bit. That entails several things. Short-term notes payable. This is going to be your bonds. Things like bonds, loans that you loan to other people, or that other people loaned you that you have to pay back. And keep in mind too, this comes with interest. I guess we can underline that. If you're going to borrow money, you should expect to pay interest on it. Expect to pay interest. Okay. Now we can hop down to, I guess we'll include, just for the sake of consistency, we'll include other, let's not underline that, other current, long-term, or no, we're still on current, other current liabilities. Okay, and now we go down to long-term liabilities. Like I said before, this is going to be over a year. Okay, let's underline and bold that. Okay, so what do we have for long-term liabilities? These are going to be things like long-term notes payable, and this is going to be long-term notes payable. This is going to be things like bonds / loans that are over a year away from payment. So like, let's say I sign a note that's due in 2027. I get the money for it now and I have to pay it back in full in 2027. That's a long-term liability because I'm on the hook for it. But at the moment, I don't have to pay it. Okay, and how do I want to say this? Because this is pretty important. I guess we can do it like this. You're also going to have contributed capital. This is going to be more relevant for smaller businesses. Maybe we shouldn't talk about that for now, but I think we should talk about retained earnings. Okay, so how could I say this? Current assets, there's the accounting equation. That's a good thing to write down too. All right, let's write that down. The accounting equation. So what is the accounting equation, you may ask? Well, I have the answer. The accounting equation is assets equals liabilities plus plus shareholders' equity. So what does that mean? Your assets are the current and non-current assets, which is here, that A. The L is liabilities. That's current and long-term liabilities. And then you're also going to have your stockholders' equity, or also called shareholders' equity. They're interchangeable. I guess we can write that down. Shareholders' equity and stockholders' equity are interchangeable terms. Okay. Not shareholders. Let's go. Here we go. Okay. So your shareholders' equity is going to be money you put into the business yourself as the owner, founder, or an investor. That's basically a startup. Money that you put in yourself. I can write it down. Startup money that you put into the business to fund it. Okay, so that's one component of shareholders' equity or stockholders' equity. I usually refer to it as shareholders' equity, but I think the text uses stockholders. Whatever is fine, they mean the exact same thing. So retained earnings, what is that? Your retained earnings are going to be your year-to-year money that you keep in the business, I guess would be the best way to say it. I wonder how the text, that's a pretty straightforward definition. I don't know if I have to look it up. So basically, let's say it's 2017. We're going into 2018. We keep $210 million or whatever it is. We keep that in the business for future, for future investments or anything of that nature. That's what money we keep. We're not paying it out into stock. I guess this is another way to think about it. So we get our net income figure, which you see that, for the year. There's two things we can do. We can do once we have our net income. We can either, one, we can keep it as retained earnings within the business, keep it as retained earnings within the business, or two, we can pay it out to shareholders, or a portion. Maybe we say we can pay a portion of it out to shareholders through cash stock cash dividends or stock dividends. Actually, it's just cash dividends because stock dividends is a whole different thing. We'll just say cash dividends for now. Okay, so this one here is your retained earnings, the money we keep within the business. I think that's a fair start to where we're at. That kind of explains. I guess maybe you know what I'll do is I'll just hop over to Safari here, go to my favorite page in the whole world, sec.gov, and let's go to a company like Apple. And then we're just going to hop over to a balance sheet, and I'll show you. As you can see, I haven't looked at Apple in about 3 quarters now. There's reasons for that. Let's just hop over to 10Q. We should be able to find a balance sheet quickly. Okay, here's a balance sheet. So, what did we go over? Current assets, cash, boom, cash and cash equivalents. Cash equivalents is cash for all intents and purposes. Marketable securities, short-term marketable securities. Okay, we see that right here, marketable securities. What else do we have? Accounts receivable. AR. That's net accounts receivable. Same thing. Inventory. It's going to be their phones, their laptops. Inventory is right here. They have billion worth of it. I think in millions. Yeah, they have $5 billion worth of inventory. Vendor non-trade receivables. Okay, this is a little bit more complicated. Most oftentimes, too, you're going to see some things on the balance sheet that won't make sense initially, or they're not covered within this broad spectrum of what I just described. But you can just Google search it, and it should, or you can read through. They'll explain what it all is down here. I could probably find it pretty quickly, but we'll just stick to this for now. Okay, other current assets, like I said, we'll flip back to here. Other current assets. Boom. There they are. $13 billion worth. Okay, non-current assets. PP&E. Let's see. There's your PP&E. That's going to be your Apple stores, your factories to make it, all the machinery you need to make a phone and a laptop. That's all here. Let's see. There's our liabilities. We got our accounts payable, other current. Let's also talk about deferred revenue. That's a good one to. Did I talk about that? No. Okay, we should add that. So deferred revenue. What is deferred revenue? Well, it's money that we got for a service or good that we have not provided yet. We can write that down. Money we received, I guess that's a better way to put it, in advance for a good or service we have not provided yet. Okay. I.e., example. Let's see if I can get that right. Okay, it's going to capitalize it. That's fine. Okay, let's say I get a pre-order for the new iPhone. Or that would be an example of a good that we have not provided yet. So, like I said, think about liabilities as you're on the hook for it. Deferred revenue is considered a liability because you are still liable to give the purchaser or the person who gave you money, you're still liable, you're still on the hook to give them that good or service. So, like the new iPhone, you're still on the hook to give them the new iPhone. Or let's say you're a lawn service company and someone pays you for the next 5 months and they give you all the money up front. You still have to cut the lawn for the next 5 months, but you're not going to be collecting after every time because you're liable to cut their grass or you have to give them a refund. Or cutting grass. We'll just say that. Pretty simple. Okay. I think that's a good start for now. I guess we can briefly talk about stockholders' equity. Common stock and additional paid-in capital. So you see your retained earnings. That's what I spoke about before. They have $15 billion in retained earnings. So that's the money they're keeping in the company. Okay. And then, as I said before, this is important to note. When I talked about this accounting equation, assets equals liabilities plus shareholders' equity. Total assets, right here, $337 billion. Total liabilities are $267 billion, and then once you add in the shareholders' equity here, another $69 billion. These two figures, $337 billion, $158 million in total assets, equals the total liabilities and shareholders' equity, $337 billion, $158 million. So that is very important to know. I guess, can we highlight on here? I don't really know, to be honest with you. Doesn't look like the shortcut works. We'll just underline it. That's very important to know. That's the heart of the balance sheet, pretty much. Okay, so now that we're through that, I guess we can start. I guess if I can show you see if you can see it. Let me go on OBS here. So that was just this chart I explained right here. I can't really get it in frame. Right there. Now I'm just going to kind of go through the headings, and I guess we can see what they have to say about each thing that I just talked about, see if there's anything I can add on. Okay. I guess I'll just read from it. Read some definitions, at least. Current assets consist of cash and other assets that will be converted into cash or used within the normal operating cycle of a business or 1 year, whichever is longer. So most of the time, a normal operating cycle is 1 year for most companies. So that's just important to know. A normal operating cycle is the average period of time between the payment of cash to deliver a service to buy goods for resale and the subsequent collection of cash from customers who purchase those services or products. So note how it said before, whichever is longer between 1 year and that. Most of the time, that's going to be the longer thing between those two is going to be the 1 year. Okay. Liquidity. That's another important, I guess we can write that one down. That's a fairly important term. Liquidity. So what is liquidity? The book defines it as the ability of an asset to be readily converted into cash. That's a pretty straightforward answer. I guess we can just simplify it a little bit. How easy we can turn something into cash. That's a good way to say it. I mean, pretty similar, pretty analogous, but oh well. Okay, then they go ahead and give an example from Apple, just like we looked at. I didn't even plan for that to happen, but it's still, I guess it's still relevant. Apple's a pretty easy company to look at. So, then they go into long-term assets, property, plant, and equipment. I guess we can add this to our definition of it. PP&E. So what do they say PP&E is? It consists of land, buildings, equipment, vehicles, furniture, and fixtures that a company uses in its day-to-day operations. That's important to know. The day-to-day operations bit of that is pretty important to know because if it's not used in the day-to-day operations, it is not classified as property, plant, and equipment. It's classified as something else, whatever it falls into. So let's say, let's just say land, buildings, other equipment used in day-to-day, and that's DTD normally, that's how you say that, or that's how you abbreviate it, operations of the company. Okay. What else does it say? Investments into property, plant, and equipment, or PP&E, are often referred to as capital expenditures or capital investments. Write that down. Capital expenditures. When you hear capital expenditures, that's what they're saying. It's expenditures required to get your capital, I guess you could think of it as. Intangible assets. Okay. I kind of already touched on that. We'll see what the book has to say about it. We'll see if we can add anything to our definition of it. Intangible assets consist of brand names. Okay, that's another good one, actually. I guess that's kind of in trademark, but it's, I guess we can write that down. Brand names. So you can't use the name, I don't know, Logitech, or I just said that because I have the Logitech mouse on me, or, you know, it can be anything. You can't make a chip, a potato chip, and call it Lay's, because it's a brand name, and they have that trademarked. Okay, what else? Patents, trademarks that the company acquires. These assets are referred to as intangible because, unlike buildings and equipment, they lack physical presence. Like I said before, you can't touch them. Okay, intangible assets enable a company to generate revenue from its customers who recognize the quality associated with products bearing a brand name or trademark. Okay. Whoa, something just fell upstairs. Other long-term assets consist of resources that a company consolidates into a single miscellaneous category for purposes of presentation on the balance sheet. So, as I said before, anything that doesn't fall into one of these one of these categories, is going to fall into the other long-term assets. But obviously, that's going to be different for each company. What exactly it is? It just depends on the good or service that they provide. So, what's next? Current liabilities. Current liabilities consist of liabilities that must be settled within the normal operating cycle or 1 year, whichever is longer. Like I said, normally 1 year is going to be longer. Let's see. 4 types of current liabilities in this example. That's provided in the book here. We get accounts payable, accrued expenses payable, short-term notes payable, and other current liabilities. Okay, it talks about accounts payable. Do I have anything? I guess we can write a definition for accounts payable down. Accounts payable, let's see what they say. It reflects the amount owed for inventory that was purchased from suppliers on credit. Yeah, so that's important to know. If they pay with cash, wait, that should be, yeah, okay. if they pay with cash, then we don't have a need to utilize the accounts payable account because it's directly converted from inventory into revenue. If they buy it on credit, then we owe someone a product or service. So we need to, how could I say that? We owe someone a product or service, so they don't have, we don't have a need to necessarily call it payable if they paid cash. It's kind of an intermediate account. It's not a permanent account, which means that normally, if everything is settled and everyone's paid properly, this account should be zero. So we owe a product or service to someone, to a customer who bought on credit. Okay. Long-term liabilities consist of debt obligations not due to be settled within the normal operating cycle or 1 year. So normally a good rule of thumb is we can just say long-term. We'll just write this down just to make sure. Long-term versus short-term. Short-term. We got here. The cutoff is 1 year. Anything over is long-term, anything under is short-term. And that talks about stockholders' equity, talks about how you present it. I don't know if it talks about GAAP here. Maybe it does. We'll see. Don't think so. Okay, so now we get into what we looked at in episode 1, which is the income statement. That kind of tells you how we make our money. So we did it with Coinbase. I guess we can, probably should make this a little bit larger so make sure everybody can see here. Let's make it about that big. I know my face cam's somewhere down here, but I don't know how low it goes. So you know what we'll do is we'll just tab this down here. And then we'll call this balance sheet. And then up here, because I know you guys can see up here, this will be income statement. Okay, so what are we looking for in an income statement? A single-step income statement is the simplest form of an income statement. Okay, let's hop down here. That's pretty irrelevant. Okay, so here's the good stuff. Okay, let's see. For a merchandising company, the cost of goods sold is subtracted from the firm's net sales to determine its gross profit on sales. So that's a good thing to say, or a good thing to note. Gross profit, as you remember from episode 1, we did talk about that a little bit. Also called, I guess, gross profit or gross profit on sales, but we're talking about the same thing. That's going to be your difference between net sales and the cost of goods sold. This is also abbreviated as COGS. If you hear me say COGS, that is that's what I'm referring to. I'm referring to the cost of goods sold. Okay, what else do we have here? And then talks about net sales, total sales, less an estimate of sales returns and sales discounts. I guess we can write that in. I guess that's somewhat important. I guess, let's see. Okay, I can probably stay on for another half hour, so I want to make sure that I'm going at a good enough pace to get through at least this chapter today. I don't think we really have to worry about the cash flow statement today, at least. That's going to be something we're going to look at once we're kind of done modeling, and then not done modeling, but done transferring our data in, and then once we start looking at how to forecast, then we're going to utilize the cash flow statement. But I think for now we don't have to worry about that. So, okay, I think we're at a good pace for now. Okay, so we can write that in. I have time to write it in. Net sales. Net sales are going to be your gross sales. I guess, could you say gross sales? Or sorry, no, total sales. Total sales minus your returns and discounts. Keep in mind too that this is an estimate, since you don't know how many people are going to return it and how many people and what discounts you're going to give. Normally you have some sort of algorithm that you can estimate for the year. Normally this estimate is, estimate is based on history. And I guess what else is it based on? You could say it's based on other patterns within the same sector, maybe is a good way to say it. Or maybe, yeah, I guess you could say sector. So, example, I guess there's another thing you base your estimate on is testing. Based on history. So what do you have? History, other patterns within the same sector, and then product testing. So for example, let's say you run a test of a new fish finder. Fish finder, it's electronic and it fails, let's say 2% of the time. 2% of them fail within 3 months. And then let's say you don't accept returns over a year, and then maybe 4% fail within a year or something like this. This is just an example. These are completely made up numbers, and it's going to differ for the product, and that's why you do product testing, is to see how many of them fail. So Fish Finder fails 2% within 3 months, and it also fails 4% of the time within a year. And then let's say if it fails within 3 months, full refund. And then if it fails within a year, you get, in-store voucher or something. I don't know. I'm just making this completely up. It's different from company to company, and they're going to tell you in their 10K and their 10Q what their policy is normally. Otherwise, you should be able to look on some different websites. Quick Google search should tell you some of their return policies. Okay. Don't accept returns over the year. And then you could use this information or info to make an estimate of product failure. And I guess it's also important to note that once you make this estimate, let's write this down. Once you make this estimate, it factors, or it has, I guess you'd say it has monetary consequences. So let's say I'm not going to write this down, but this is just a quick example to kind of illustrate it. Let's say you do $100 million in revenue, and you expect 10% of that to be returned because of product failure. You have to think about that kind of in your business model, that you're now only making $90 million in revenue. You lost $10 million because the product failed. That's why you should make the best products, so you don't have to worry about this. Okay, so we'll continue on. It talks about a multi-step income statement. That's normally what we look at. Okay, that's, I guess, important. We can say other revenues that we make outside of revenue on our product or service. There's a few other ways we can make revenue. Interest revenue, also called interest income, which you see this a lot. I know we saw it in Coinbase, I believe. If you're loaning someone money and then they pay you back with interest, that's interest income. What else do we have? Well, we have gain on the sale of a fixed asset. That's another one. Let's say I bought a new machine that makes laser precision cuts or something like that. And then after 10 years, I want to sell it. And I sell it. I bought it for $50,000, and it became really rare, and people couldn't find them. And I sold it for $100,000. I think I said I sold it or bought it for 50, sold it for 100. That's a $50,000 gain on the sale of a fixed asset. Okay, so what else do we have? Dividend income. Pretty self-explanatory. Money you make from dividends. If you're invested, like down here we talked about marketable securities. Let's say you're an owner of, like, your corporation is an owner of a high-paying dividend stock such as AT&T. The money you get from the dividends that they pay out is classified as dividend income. Okay, so what else are we going to see on our income statement? So I guess I probably should have stated this before. An income statement says, it tells us classifies, I guess you could say, classifies the gains and losses we made. Okay. And then what are we going to have for other expenses? I know I talked about other expenses, things that don't fall into one of the main categories. I can go back and briefly talk about the main categories that we saw, but a lot of them are pretty self-explanatory. So what do we have? We have interest expense, same thing as interest income. We also have loss on the sale of a fixed asset. That's the same thing as gain on the sale of a fixed asset, except you lost money on it. So you bought it for $50 and sold it for $25. You have a $25,000 loss on the sale of a fixed asset. Okay, so the book doesn't really dive too deep into like kind of the main categories, but I guess I can touch on them briefly. So what do we have? We always see revenue, mostly. Depending, 90% of the companies you're going to look at, I guess 100% of the companies, how they make their money is going to be classified under this revenue tab. Products or services sold. That's just the total number, and then we also have we're going to have our operating expenses, and this is what it costs to make that revenue, what it costs to generate the revenue. Okay. Operating expenses are going to be things like research and development, and this is abbreviated R&D. I'm sure you've probably heard that before. What else do we have? Selling obviously this is going to differ from company to company, but this is a pretty standard one. I should probably type that out like I did the other one. Selling, general, and administrative. This is abbreviated SG&A. This is going to be marketing. I guess they probably break up marketing. Okay, normally they do. This is the money that it costs to put it in retail stores, I guess you could say. Market the product, and also pay salaries. That's what administrative costs are. Okay. Briefly talking about some other things. Okay, I guess that's pretty much as basic as it gets. So what we're going to do is we're going to, especially when we look at, bigger companies, we're going to look at their revenue. I guess we can kind of do the process. This is what we're trying to do here. The process. What we do number one, look, let's try that again. Look at the, can't really type right now, company's revenue. Then we're going to look at the operating expenses, which, as I said before, is the money it costs to generate your revenue. And then we're going to come up with this figure called operating income. And then this is going to be your revenue minus the cost of goods sold. So I guess let me make this a little bit more clear. Sorry. You're also going to have, so you have your revenue. You're also going to have your COGS, your cost of goods sold. So revenue minus the cost of goods sold is going to give your gross profit. Probably should have talked about that when we actually talked about gross profit, but it's not really too big of a deal. Gross profit, which is the difference between net sales and cost of goods sold, gives you your gross profit. Then we're going to look through the company's, I guess we're going to look at the company's gross profit. Look at the operating expenses. And then we're going to come up with this figure called operating income. Operating income, which equals gross profit minus operating expenses. This is going to give you your operating income. And then we're going to go through, look, I guess we can make this number 3, it still counts. Look at other income and other expenses. Subtract these. Subtract slash, I guess. So you're going to want to total our operating income. Take that, and then add your other income, and subtract other expenses. I guess we can just write that out. Operating income plus other income minus other expenses equals income before income tax. Okay, so that's the money we're making before we get taxed. Then we're going to have our taxes, whatever, and then these taxes are not their tax rate is, I guess we factor into how we structure our taxes, but for the most part this is non-controllable. I don't know if I want to write that, but we get taxed. I guess we can just keep it simple. We get taxed. Then we get our tax, which is also called income tax expense. That's a more precise way to put it. And then what we do is we're going to take this income before income tax minus income tax expense. That's pretty straightforward. This equals our net income. This is the holy grail. That is what we're looking for. So that is kind of how our plan of attack is when we're looking at these bigger companies. And as I said before, when we look at some income statements are not going to have exactly how we have it. There's going to be some different categories. With Coinbase there was. Very few companies are just going to have just these and nothing else. Some of them are going to have this and a few more. Some of them are going to have less than this. Some of them are just going to be completely different. So you just got to sort through it and just kind of figure out what exactly you're looking for. But it's important to know that everything is, you're going to have, they might break down their revenues, but it'll say revenues. And then you just kind of got to figure out what are their operating expenses, what are classified as their other revenues and their other expense. And then you walk through this process and you walk it down into the net income, and that's pretty much the key. So I guess now, I don't know if we want to talk, I guess we can talk about, should we do some quick ratios? 435. Okay, I'll just quickly write down some ratios. We'll talk about a little bit of analysis. This is not exactly what we're here to do, but it's still important, and they can be pretty telling. Some of these ratios here. It can tell you things like about how their liquidity is. Where do I have liquidity written down? Right here. How easy we can turn them into cash. Solvency. What else? Basically, the ability for us as a company, the ratios that I'm about to write down are going to tell us how well we can pay money back over time. If we owe people money and, worst comes to worst and we go out of business and we can't continue anymore, how easily can we pay people back that we owe money to, or goods or services, and how quickly can we do it too. So that's a pretty important thing. It's not super important, but I guess just for this video to understand these concepts, we can reinforce it with some of these ratios. So what do we have? I know I talked about some of them too. I'll talk about margins here too. So ratios and margins. Margins are going to be a little bit more helpful. I guess we can note this. Margins can be more helpful because we can compare them to industry averages and see how we line up against our competition. For example, AT&T and Verizon. Let's say I'm AT&T. Let's say AT&T is spending twice as much more on marketing or something, or maybe R&D for 6G. Maybe that's the next thing. AT&T is spending twice as much more on R&D for 6G. This is our example. Why? Why these margins tell us that there's a difference, and it could either be good for the company or bad for the company. But why are we spending twice as much more on R&D for 6G? And do you think that that would be a good way to generate more revenue in the future? So that's why I like margins more, because you can physically stack them up against your competition and see how well you're doing. Or other example, we'll just keep the same AT&T and Verizon thing going. Let's say AT&T, obviously these are made up numbers. I haven't looked at AT&T in a while, but let's say their net income is, well, I guess this is a ratio too, but okay, we'll save that for when we go into the ratios. So some ratios that we need to look at for sure. We need to look at return on assets. I briefly touched on this, I believe, in episode 1. That's ROA, how we abbreviate that. And this is just net income over total assets. Let's go with the AT&T example. I'm just going to keep that going throughout this whole thing. Make sure we're good on time. Yeah, I can probably go for another 10-15 minutes, so we can start to wrap it up here shortly. But we'll just briefly touch on these. So talking about the example, why is AT&T's ROA, 17% or whatever, 7% lower than the competition. It can be very telling into business, why, if you're not making the returns you expect and the industry is just crushing you in returns or any of these other ratios, it tells you that you got a problem and you got to fix it. And if we're looking for a good investment, we want to kind of avoid these companies that are, I guess distinguishably lower than the industry average, and there's no good reason for it. If there's a reason for it, then maybe we can reason ourselves into making a good informed investment on it. But for the most part, if we're getting crushed on some of these returns and some of these margins, it can be a sign to stay away, but not always. Okay, so another one is the current ratio. All this is current assets over current liabilities. Let's make this current liabilities. This can tell us this, and it kind of looks like minus. Let's do a colon. This tells us how easily we can pay off short-term obligations. That's important to know. How liquid we are. How liquid are we? Okay, so now quickly, side note, I guess I'll just put it a little bit down low here. Solvency, I mentioned it previously, but I never talked about it. How easily we can pay long-term financial obligations. So, one ratio that can tell us how solvent we are is something called the debt to total assets ratio. And this is going to be total liabilities, not just current, but total, over total assets. And then, so what we're going to ask ourselves is, can a company meet its long-term obligations? Well, we're going to assess the DT, I'm just going to abbreviate this, DT, debt to total assets ratio. That's what I'm talking about there. And then, well, when we assess it, a larger ratio would imply a low solvency and a reduced ability to pay back outstanding obligations over the long term. Okay, do they have any other quick ones in here? Okay, we'll just quickly go through a couple more of these. Maybe one more. Yeah, just one more. This will be the last margin and ratio we look at. Return on sales ratio. Return on sales ratio is just net income over net sales. And what does this tell us? Well, you could say that this, in a sense, maybe I'll talk about this more in a later episode, but tells us how efficiently a company runs. Okay, we'll just leave it at that for now. Okay, well, let's see. I'm just going to wrap this up in here. Wrap this up with ratios, and then I'll do a quick review just briefly, and then we'll call it good for there. I think we went through a good amount of terms here, and I think hopefully you have a better understanding of kind of the balance sheet and income statement than you had prior to this episode. And we're not going to worry about the cash flow statement just yet. We will eventually. Finance, episode 2. That's something, okay. Well, okay, briefly wrapping this up. Wrap up. We're just going to wrap up ratios and margins. What do they tell us? Well, how good do we stack up against similar companies? this is very important. I can't stress how important this is. When we look at companies like Google, who makes, cloud-based computing, or maybe we look at, maybe that's not the best example, but, a software company like Google. Or no, maybe this is a good one. How about Twitter, which is the ticker TWTR? I'm just going to write Twitter because I don't remember. Twitter versus Facebook, or Meta now. How well does Twitter operate compared to its competitor, Meta? Well, we assess these ratios to tell us how we are operating. The numbers really do tell a story here. Okay. I guess that's good enough for now. We'll have to go over cash flows maybe once we get there. But I kind of think my plan is for now is to move into another company next episode, kind of go a little bit deeper than we did with Coinbase, just because we couldn't really, fully dig into it when there's only 3 10Q reports. Okay, so it's 4:46. I'm just going to do a brief few-minute wrap-up of what we talked about today. I won't wrap up ratios and margins because we just talked about it. But so the income statement talks about the gains and losses we made. We're going to have things like gross profit, and this is going to be the difference between the net sales and the cost of goods sold. Net sales is just, all that is total sales minus returns and discounts. It's an estimate. So I went through a brief example of how we estimate it. There is, maybe in a later course, later in the course we can talk about how you actually estimate, like the algorithm that you use, or the formula that you use to make an accurate estimate. And then we're going to have things like revenue on the income statement, operating expense, that's what it costs to generate the revenue, and some examples of operating expenses are R&D, which is research and development, and SG&A, which is selling, general, and administrative. Okay, so the process that I kind of walked through in the Coinbase episode and how we're going to be doing it the rest of the time, you find the revenue figure, subtract the cost of goods sold, that gives you gross profit. So we take that gross profit, then we're going to look at the operating expenses. We're going to find the operating income, which all that is gross profit minus operating expenses. Once we get our operating income figure, we go down to other income and other expenses, and this gives us income before income tax. Once we take our operating income, add other income, and subtract other expenses. Then we're going to have an income tax expense. Every company has it. And then that income before income tax minus our taxes gives us our net income. And that's the holy grail of of the income statement. Okay, the balance sheet quickly. Just one more minute here. The balance sheet we're going to look for more in future episodes. Can't really do it with Coinbase, but we're going to try and do it next episode. So the things we have on the balance sheet: cash, short-term marketable securities, which are things like stocks, accounts receivable, inventory, non-current assets, PP&E. We talked about PP&E a little bit. Intangible assets, you can't touch them, literally, not figuratively. Current liabilities, accounts payable, we owe something to someone who bought it on credit. Deferred revenue, we talked briefly about that. That's a pretty important concept, especially, or for some companies more than others, but it's still an important term to know. Short-term notes payable, and we're going to long-term liabilities, retained earnings. That's, we should also label this stockholders' equity, because that's what it is. We'll break that up from long-term liabilities. So the net income for the year, this is just explaining retained earnings. And then I know this is right next to my face cam. Let's see if I can push it up a little bit. Oh, okay, I can. Perfect. We went over the accounting equation. Assets equals liabilities plus shareholders' equity. Liquidity is how easily we can turn something into cash. And then, this is important, the long-term versus short-term, the cutoff is 1 year. Okay, that's a quick brief wrap up. Thank you guys so much for watching. I'll see you next time in episode 3. I'm planning on looking at doing a deeper dive into a company, so if you have any suggestions on a company that you're interested in, don't hesitate to reach out to me. Just leave a comment down below. And then until then, we'll see you guys. Take care.